Yes. How will she get the handout? All right. You have to give her the handout, eh? This new student. All right. So we have two models to go. We have what we call Fulmer model, which is on page number 45. Fulmer model, H-score model. The Fulmer model, also known as the H-score model. So don't take lots of time on this. It has never been tested, but it's good for you to know that you could also be the very first candidates who can easily be tested on this. When you talk of Fulmer model, it basically makes use of 9 ratios. 9 ratios in total. And if it comes, the formula will always be given to you. So no worries. The formula will be given to you. Like you can see there, H equals 5 point whatever x1 all the way up to x9. And then most importantly is that they will guide you how to get those ratios. So for example, X1, they're telling you it's retained earnings over total assets. X2 is sales over total assets. X3, so it will be very easy to be given all the data which you need. The only thing that you need to be very, very careful about is X6, which wants you to get total assets, and then you get its logarithm. Could you kindly give me the logarithm? Let's try. Assuming in this case here that our total assets are 100, eh? If our total assets are 100, what is the logarithm of this 100? Punch in your calculator there. Logarithm of 100. Punch in your calculator there. Logarithm of 100. It's 2, eh? I hope you're able to see the logarithm. Don't tell me that the last time you saw logarithm was when you were in high school. I hope you're able to see the logarithm in that calculator. So that should not scare you at all. Yeah, because you'll simply follow the rules. You'll simply follow the rules. All right. And then we have in this case here, you can see X7 is working capital, everything. Also be careful with X8. You need to get log over that quotient. Eh? Now, the most important thing, ladies and gentlemen, under the Fulmer's model, you need to know how to interpret the H. So in this case here, we have our H. H0 is neutral. And then, of course, we have now this side will be negative. This side here, H will be what here? Positive like that. And we are told that if H is greater than 0, if it is positive, then this organization is financially sound. The organization is doing very well. If H is 0, that is ish, it's a gray zone, requires further analysis. And if H is negative, it is an organization which is financially what here? Distressed. So everything will be given to you guys. Should they give us a question on Fulmer, everything, what you need basically is confidence, and then now get to basically follow the numbers given for you to be able to get those ratios, 9 of them, and then you substitute them like that. Fulmer model. Is that okay, ladies and gentlemen? Is that okay, ladies and gentlemen? Do you think with that guidance, should they give us a question on Fulmer, will you guys be able to write something or nothing? Don't tell me nothing. It's all about your confidence. If you're not confident, of course, nothing, right? Then now we go to this one that is very, very popular. You'll be able to read those things, advantages and disadvantages. You'll be able to read them. We go to this one that is very, very popular, known as the Argentis A-score model. This is very, very popular in your exam. Argentis A-score model is really popular. And I hope you are able to access the handout. It's on page number 47. 46 actually, at the bottom there. You're able to see Argenti's A-score model, which was developed by John Argenti in 1976 before most of you here were born. This model identifies non-financial and managerial weaknesses that lead to corporate failure. Unlike Fulmer, it is a qualitative and diagnostic model. It's qualitative, focuses on why a company fails, not just whether it will fail. So it is a qualitative model. Argenti argued that failure is a process and not an event, beginning with poor management decisions and the control what here weaknesses. The structure of the A-score model, the first thing that will normally happen is that we are going to have defects in the organization. These are internal control systems, weaknesses of internal control systems like that. Now, once we have these defects, then the managers will make mistakes. After mistakes, of course, now we shall be able to see symptoms. Unfortunately, by the time we are seeing symptoms, it is really too late. So in this case here, we'll expect what we call what here failure. This is what I want you to draw. Anytime they ask you about Argenti's A-score model, you must always draw that. Yeah, before this is supposed to be a process, eh? Yeah, so first of all, you go to an organization which doesn't have what here internal control systems. Or if they are there, they are very, very defective. If they're defective, then the people inside there will take advantage of those weak internal controls to steal from the company. And we shall be able to see so many mistakes happening. All right. And then, of course, once these mistakes happen, we shall be able to see things there. Yeah, symptoms. And then lastly, we have the failure of the company. So defects, management weaknesses, mistakes, strategic and operational errors, symptoms, financial or bad performance outcomes. You can see the scoring of Argenti's A. You can see under defects, up to 45 points. Defects, examples of defects are which ones? For example, poor management, where in this case here, your managers are incompetent, they lack depth over how to run the business. The CEO, for example, is autocratic, is a dictator. Weak financial controls, lack of management accounting systems, poor response to what you have to change. So I would want you guys to score, to give your organizations a score in terms of number one, defects, out of 45 points. How many marks? I would want us to do this practically. So in terms of your own company. So if your company is doing very, very well, it's non-defective. If it is non-defective, you rate it at 0. And if it is very, very defective, you give it how many points? Are you able to see the maximum is 45? You give it 45. So how do you look at your company? Look at your CEO. Does he have depth of managing your company? Is he really good in what he does? Is he a dictator? If he's a dictator, he's too defective, right? So you write 45. Mistakes up to 30 points. So mistakes, basically, ladies and gentlemen, please listen here. Mistakes, what are we looking at? So mistakes, these guys, once the internal control systems are so weak, once we have a lot of management weaknesses, then automatically, they don't know what to do. Once they start realizing that things are not going on very well, they will start getting into mistakes. Mistakes like which one? Over borrowing. So in this case here, if your company has lots of loans, that's a mistake. Especially if that money was borrowed and misused, a mistake. Another mistake, ladies and gentlemen, that these managers will always get into is what we call overtrading. Overtrading, because they want to show off that they're doing very well. Like Nakumat, what do they start doing? They start opening anyhowly until they get into what we call thin capital. So in terms of this maximum of 30, how many marks will you give your company in terms of mistakes? We shall overcome. I hope you guys are giving your companies marks, and then they shall be able to add all of them. We get to see. And don't tell me that you're not working. So mistakes over trading, expanding without adequate capital, high gearing, large acquisition mistakes. Yeah. Over investment in unprofitable water projects. Then we have symptoms. Symptoms up to 25 points, deteriorating liquidity, You don't have enough liquidity, declining profitability, high staff turnover, or if, for example, you got a qualified audit opinion in your last year's financial statements. So have you been able to put a score there? I know nobody's doing total 100. So interpretation, ladies and gentlemen, if, for example, you scored your company, your A score is in between 0 to 25, then the company is very healthy. 26 to 35, early warning signs, monitor closely. 36 to 50, financial distress is emerging. More than 50, high risk of what here? Somebody, actually, that's a failed organization. So I don't want you to go into all those issues, ladies and gentlemen. The most important thing is for you to know that whenever we talk of Argent's A score, unlike all the other models, this is the only model that looks at how a company is performing or bankruptcy in a company, but now using what we call qualitative factors. They're not looking at numbers. They're looking at qualitative factors. Yeah, ladies and gentlemen, remember that money can never be everything in this life. Yeah, money can never be everything. Although there are ladies who tell me that, Mwalimu, I would rather be seated there and crying, but inside what here, Mercedes Benz. I really disagree with that. Happiness has got everything. Has got, happiness, being happy is everything, is everything. Being happy is everything. So remember, like Argent is A score is the only qualitative model. And how do we move around these Argentis? It says that for an organization to collapse, ladies and gentlemen, there are some basic steps. The very first step is which one here, somebody? A company having defects, isn't it? After defects, we talk about what here? Mistakes. From there, we talk of symptoms, and then we talk of what here? Company failure. Company failure. Thank you, Purity. Great, great. Then now, with your permission, we shall be able to straight away look at the effects of reconstruction on WOTR ACC. Effects of reconstruction WACC. April 2022, question number 40. So effects of this financial reconstruction on WACC, April 2022, question number 4D. April 2022, question number 4, dog. Once you get the question, kindly mention there why for yes. Why for yes. Once you get the question, mention there why for yes. Thank you so much. Thank you so much. Why for yes. Thank you so much. So Viwanda Limited, is that okay? So Viwanda Manufacturers Limited, current EPS is what here, somebody? 5.0. The company has an asset beta of 0.9 and adopts a 40% dividend payout ratio as its dividends policy. The risk-free rate of return is 5% and the equity market risk premium is 10%. The management of Viwanda Manufacturers Limited intends to undertake a financial reconstruction which will result in a debt-to-equity ratio change from 0.15 to 0.3. Debt is considered to be risk-free. Corporation tax applicable is 30%. Show the impact of the financial reconstruction on the W what here, somebody? ACC. This is very, very easy. This is really easy. So we shall do a small table like this. So we have here before reconstruction and after reconstruction. A small table like that. Before reconstruction and after reconstruction. Yeah, which question is this? It is April 2022. April 2022. Question 4D. Question 4D. Question 4D. All right, question number 4, dog. All right. So before reconstruction, what are we told there? Look at the last paragraph. There are only 2 paragraphs. So second paragraph, where they're giving us debt to equity ratio. Debt to equity ratio. So the old debt to equity ratio was 0. What here, somebody? 1.5. And they intend to borrow more because you can see the new debt to equity ratio is increasing. You can see we are moving from 0.15 to what here, somebody? 0.3 like that. So it's important for us to be able to really know this. The reconstruction is about taking more debt. More debt. All right. So now, ladies and gentlemen, please listen and listen to me very well. You can see the company has an asset beta of 0. What here, somebody? 0.9, isn't it? So we have an asset beta. Asset beta of 0.9. So remember, we have our little notes here. You can do our little notes here. That asset beta is used to measure systematic risk. Systematic risk of unlevered firms. So notes, asset beta is used to measure systematic risk of unlevered organizations. 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 Yeah, great. So anytime we talk about, ladies and gentlemen, assets beta, it is used to measure systematic risk of unlevered organizations. So we must get a way of changing this beta to what we call equity beta. What we call equity beta. So mention there, use Hamada's model. Use Hamada's model to calculate equity beta. To calculate equity beta. To calculate equity beta. Why do I want equity beta? I want equity beta, ladies and gentlemen, simply because I can see that my companies here have got what here? Debt. So equity beta is the one for organizations with debt. Equity beta. So, and how does this Hamada's model look like? This Hamada's model is interesting. The Hamada's model tells us that Bell will be equal to BEU like this into 1 plus debt over equity less tax, like that. Less tax. My network has a problem? I doubt. I doubt. Mine seems to be very stable. I can see. Mine is very, very stable. So we are using Hamada's model. And this Hamada's model looks like this, clear. Great. So Hamada's model, Bell should be equal to BEU into 1 plus debt over equity into 1 minus tax. Into 1 minus tax. So this Bell stands for beta equity of a levered firm. Right there, that Bell stands for beta equity levered organization. Beta equity over a levered firm. A levered firm is a firm with, you guys are letting me down, debt, isn't it? A firm with debt. A firm with debt. How about BEU? BEU is beta equity over unlevered firm. BEU is beta equity of unlevered firm. Beta equity of unlevered firm, also known as assets beta. Also known as assets beta. You can see assets beta is used to measure systematic risk of unlevered firms. So BEU is also known as assets beta. Beta, please don't write beta like this. Not unless you are beta. Never be beta. Don't write beta like that. It is beta like this. Beta like this. I would have asked you to look for what your neighbor has written down, but let us not go there, isn't it? Yes. So then let's get Bell for this debt to equity before reconstruction. Before reconstruction. So by the way, I expect you to know that this one is the same as BEU. Beta equity of unlevered. Yeah. Kumaanisha, ladies and gentlemen, that BEU is 0.9 into 1 plus debt over equity, which is 0.15 times 0.7. I'm 101% sure that there are some ninjas here who do not know where I got 0.7 from. Where did I get 0.7 from? Where did I get 0.7 from? 1 minus tax. 1 minus tax, because tax is given there as 30%. Thank you. And then debt over equity. You see, this is debt over equity. It is this, the whole of this. 0.15 times 0.7. So is there somebody who is able to give me this figure? Ask a question. Equity, you see, debt over equity is 0.15, already divided. Debt over equity is 0.15. Thanks for asking. The online ninjas, I expect you guys to give me an answer. Don't worry, even if it's wrong, so what? Actually, the very best student is the one who doesn't have a calculator, because they can easily shout a number 30. And then they'll tell us, no, in the process, we get an answer, isn't it? They're giving me 0.9945, isn't it? Thank you so much. Thank you so much. Now, ladies and gentlemen, having gotten this Bell, the next step, we are still working on before reconstruction. You get Bell. Bell's sister is known as scale. So after Bell, give us scale. How do we get the scale in this situation? So give us scale. How do we get scale in this situation? It's very easy to get scale. So get scale. Scale is cost of equity of a levered firm, right? I will use CAPM because I can see CAPM information has been given. Is there somebody who remembers the formula of CAPM? I may forget everything, but I will never forget that CAPM starts with risk-free. Thank you. So we have here risk-free plus ERM minus multiplied by B. And now this beta will be what here, somebody? Bell. So I'm getting CAL. CAL is cost of equity over a levered organization. Even if you write beta alone, no problem. But remember, ours is geared. So I want, in this case here, Bell, like that. So can I give you 1 minute to see whether you guys can do proper substitution? Can I give you 1 minute to see whether you guys can do proper substitution? At least today you guys are very, very many. Online we have 72, which is very, very good. Very, very good. So please talk to each other. The guys who are around here, remember your biggest strength is having a discussion partner. I'm so sure there must be a ninja at home who has nobody to discuss with. Kwanza leo mwalimu wa primary school, which is very good. But you see now you cannot discuss with them. I'm a nurse. You can't discuss with them. I'm somebody in a very different profession, isn't it? Another called pilot, but now do you discuss these things with the pilot? With a pilot, no. All right, let's do it together, right? So we have here CAPM, cost of equity of a levered farm. Do we have risk-free? What percentage? 5%. Did you discover that these guys gave you premium? You see, premium means that already they have subtracted for us. Don't subtract again. Premium, they have subtracted for us. And the premium is what here, somebody? The premium is 10%, isn't it? 10% times this bell that you guys got here of 0.9945. So are you able, ladies and gentlemen, in this case here to give us a figure now? You see, premium already they have subtracted for you, if you remember. I don't know whether you guys remember this. That this we have here, inside here, at times it is called what here? Premium. It's over and above. They have already subtracted for us. What do you have there? Is there somebody who has 14 point something? 14 point something, 14.945. 14.945%. Wrong? Are we wrong? Take your calculator. No, just take your calculator. We do it together. You can omit the percentages, right? You say 5 plus 10. Don't say equals, because most of us will say this is 15. And then no. It is only this 10 which is to be multiplied with this. So 10 times this, whatever answer you get, you add it to 5. Body mass, you multiply fast. Great. 14, isn't it? Thanks, Alicia, 14 point something, right? Now that you guys are very, very bright, remember now we are almost coming to the end of our semester, right? Meaning that already you've passed the exam. Then what do you think in this case will be the next step? Having gotten my friend called Kel. I'm a Kelvin. Kelvin is dangerous. Kabla WSCC Purity Musangi. First we shall get the weights. Because you see, to get Wakaka, we need the weights, isn't it? So go ahead and give me the weights here. Before reconstruction, we know our debt to equity. So debt to equity is 0.15, isn't it? So I want us to get the weight of debt. You see, please listen and listen to me very well. Now I'm getting the weights. Please listen and listen to me very well. If you look at this debt over equity, this will be the same as saying 0.15 over 1. Is that okay? Because you see, 1 is normally silent. Meaning that debt is 0.15 and the equity is what here, somebody? Is 1. Don't write on this space. I'm just using it briefly here. So then what is the weight of debt? We know that weight of debt will be debt over debt plus what here, somebody? Equity. Weight of debt. So the debt here, we know debt is 0.15. All right. All over debt itself again, which is point, plus equity, which is 1. So could you kindly give me this weight of debt? So it will be 0.15 over 1.15. Kindly give me this weight of debt. .13. I'm being given a figure of 0.1304. Can I give you a shortcut of doing this? A good student, ladies and gentlemen, who has ever done this kind of a question knows that if you're given debt to equity and you want to get weight of debt, you take this debt to equity ratio the way it is. You take it the way it is. You don't have to reason like that. You take this one the way it is, and then you say divide by itself plus 1, regardless. You say this number that is here divided by itself plus what here, somebody? Plus 1. That is how we get weight of debt. So then this one here will be 0.15 over 1.15. No. So this one here will end up giving us what figure? Please confirm. Weight of debt, 0.13, isn't it? Let me try you out before we continue. Let me try you out. So 0.13. Can we write 0.1304? Yeah, thank you so much. Let me try you guys. Let me try you a little bit before I start using this space here. Let me try you a little bit. What if you are given debt to equity ratio is 5? Very fast. Can somebody give me the weight of debt? 5 over 6 years. Because you take 5 all over itself, which is plus what here, somebody? Which is the same as 5 over 6. Now, you ninjas, if you've got a weight of debt here, is there somebody who can give me weight of equity very fast? If you've gotten weight of debt, are you able to give me weight of equity? I know that the 2 must always add up to 1. So therefore, weight of equity will be 1 minus 0.1304, which gives us what number? 0.88696, like that. Yeah, great. Thank you so much. Thank you so much. Thank you so much. Now it's after getting the weights that will be able to come and give us what we call wakaka, isn't it? Now you can comfortably go ahead and give us the wakaka. Very comfortably, you can give us the wakaka. Weighted average cost of, do you know the formula? It is weight of equity, cost of equity, weight of debt, cost of debt, and this cost of debt must be deducted. Yeah, must be tax deducted. So do we have the weight of equity? Yes, you've just given it to me. 0.8696, isn't it? Cost of equity is the KEL. Is the KEL. KEL, which was 14, which I've forgotten actually. It was 14 point what here, somebody? 9.45%. Do we have, ladies and gentlemen, weight of debt? 0.1304, isn't it? Times cost of debt. Is there somebody who is able to see cost of debt anywhere here? Yeah, cost of debt, it will be the risk-free rate of return. Cost of debt. They actually told us down there. They actually told us down there. They told us that in paragraph number 1, the risk-free rate of return is 5%. No. The management of Viwanda Manufacturers Limited intends to undertake a financial reconstruction which will result in debt to equity ratio, and then debt is considered to be risk-free. Many examiners can't tell you that. Many examiners, they expect you being at this level to know nowadays debt is secured. You need collateral. There are very few banks who can give you secured debt. Especially business loans, we must have collateral being given to them. And if collateral is given, then automatically it means that KD will be equal to what here, somebody? Risk-free rate. KD will be equal to risk-free rate. So in this case here, we are saying there that KD equals risk-free, which is 5 what here? 5%. So times 5% times 0.7, like that. Times 5% times 0.7. 0.7 is the 1 minus tax. It's the 1 minus tax. So then what is our wakaka, my good students? Yeah, great, great. So wakaka, I'm being told, is 15 point. Wakaka. Whose story do I believe now? Whose story do I trust? Because I have 2 students who are giving me, somebody is giving me 15%, another guy is giving me 13.45, So 13.45%. Can I ask you a question? Have we finished doing the question really? No. We have been able to get the wakaka before reconstruction. Wakaka before reconstruction. Now go ahead and give us Wakaka after who? Reconstruction. Mwanafunzi mgeni karibu sana. We are doing April 2022, question number 4D. April 22, question number 4D. So now we do, in this case here, the weighted average cost of capital. After reconstruction, this is very easy. These guys have given us the BA, which is the same as BEU. Beta assets is the same as beta equity and levered, which stands as at 0. What here, somebody? 9. So once I see beta equity and levered, I know I have to use a Hamada's model to get BEL. How do we get BEL? It is BEU into 1 plus D over E into 1 minus T. So with speed now, I know that my BEL will be equal to my BEU, which is 0.9 into 1 plus, after reconstruction, what is our debt to equity ratio after reconstruction? Remember, it was being reconstructed, the capital structure was being reconstructed from 0.15 debt to equity to 0.3 debt to equity. So debt to equity is 0.3 multiplied by 0.7. So is there somebody who is able to give us this BEL? Is there anybody who is able to give us this beta equity of a levered firm? Anybody who is able to give us this beta equity of a levered firm? 1.089. So we have here 1.089, like that. Thank you so much. After getting BEL, I'm a very bright student. I know BEL will always give birth to KEL. So KEL, I'm using CAPM. KEL, I'm using CAPM. KEL, I'm using CAPM. When I hear CAPM, ladies and gentlemen, I know CAPM formula, it is risk-free, isn't it? Plus ERM minus risk-free multiplied by the BEL that you have just obtained up there. Multiplied by the BEL that you have just obtained there. You guys have got everything, right? You have everything that you need to get these numbers. So is risk-free going to change if we are going to do reconstruction? No. The only thing changing here is debt to equity. Debt to equity. So risk-free remains at 5% plus into brackets. Fortunately, this examiner has given us the premium, meaning that he has subtracted for us. Premium has been provided. He has subtracted for us. Multiply these by what here, somebody? 1.089, like that. 1.089, like that. So somebody is able to confidently tell me that our CAPM KEL is 15 point what here, somebody? 89. So are we able to get this 15.89%? All of us? We am alone, but I will overcome. I'm alone, but I will overcome. At least there is a purity. Magdalene? Yes. Now, after getting KEL, I know that the next thing will be the weight, isn't it? Specifically, the weight of debt. Weight of debt. And the only thing I need for me to get weight of debt is a debt to equity. Will you tell me that the debt to equity is 0. What here, somebody? After reconstruction, our debt to equity is 0.3, isn't it? Yeah. Then I will easily give you weight of debt, which will be 0.3 divided by itself, but plus what here, somebody? Plus 1. You take 0.3, you divide by itself, 0.3 plus 1, which will be the same as 0.3 divided by 1.3, which will give us what answer? 2308, 2308. 2308. Now, once I get these, ladies and gentlemen, I will comfortably give you guys weight of what here? Weight of equity, isn't it? I will comfortably give you guys weight of equity, yes. So the weight of equity will be 1 minus the weight of debt. So the weight of equity will be 1 minus 2308, which will end up giving me what figure? 7692. 0.76. 92 like that, 0.7692, 0.7692. Now, ladies and gentlemen, having gotten that, now I'm so sure I can translate everything to the famous WACC, WACC, after reconstruction. So WACC will be weight of equity, cost of equity, weight of debt, cost of debt into 1 minus what here, somebody? Into 1 minus tax. And I know here where most of them will confuse as an examiner, somebody who has been an examiner before, I know most of them will not be able to get KD. Most of them will call me after exam and then they tell me, Mwalimu, fine, you taught us very well, but KD wasn't given. And then, of course, because it is towards Christmas, I will tell them it's an error from the side of the examiner to please you. I don't want to mess up with your Christmas festive. I would want where you are sleeping when you are counting your marks. At least you'll be happy that these had an error. You're counting every mark. KD is always equal to risk-free. Not unless you're told otherwise, KD is always equal to risk-free rate. So in this case here now we have everything. So weight of equity is 0.7692 times cost of equity. Cost of equity got this as 15.89, isn't it? Weight of debt is 0.2308 times KD, which is 5%. 1 minus 30%, that is 0. What here, somebody? 0.7, which will end up giving us what here, somebody? 13.03. 13.034%. So is this reconstruction good? Oh, yes. I recommend this financial reconstruction because it is aligned with the company's overall objective, which is minimizing WACC. We can see our WACC is reducing, isn't it? Anything that you do in an organization that reduces WACC is a recommendable thing. We recommend it. So this organization should undertake the reconstruction because you can see WACC reducing from this to this percentage. We can see WACC reducing from 13.45% to 13.034%. So we recommend that financial reconstruction. And if they want, because at times we do ask, if they ask, although this one they never asked, but if they asked for the percentage change in WACC, if they ask for percentage change of WACC, you take new, minus old over old, times what here, somebody? 100, So the new is 13.034% minus the old 13.45%, all over the old 13.45%. Of course, it will be negative something because of what here, because of the reduction. It will be negative something because of the reduction. So if I were you, I would forget all the percentages, talk of 13.034 minus 13.45 equals whatever answer I get, I divide by 13.45 equals. I get 0 point something, I say times 100. I say times 100. I say times 100. So what answer am I getting at the end of the day? So the evening students, I don't know whether we have done this question. If you have done it, then I will be able to December 2024, question number 2C. December, so minus 3.12. So a reduction of 3%. A reduction of 3%. So minus 3.12. So the evening students, I don't know whether we have done this question. December 2024, question number 2C. 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 Have we done it in class? Chelsea says no. Let's do it. although I can give it to you as an assignment, but you can just go through it very fast. Please get the question fast. December 2024, question number 2, Carl. December 2022. I hope you're checking this in your past papers. December 2022, 2024, I mean, 2024. December 2024, question number 2, Carl. Jamla Limited is considering undertaking a financial reconstruction during which it would repurchase its outstanding ordinary shares using debt. So debt will be increasing. This will raise its debt to equity ratio to 1.8. The following information was available for the company. We can see number 1, existing debt to equity, 1.2, asset beta is 0.6, risk-free is 6%, return on market portfolio is 12%, debt finance is considered to be risk-free, the corporate tax is 30%. So they want us, number 1, to give them the firm's levered equity beta before and after reconstruction. They want you to give them Bell. This one I will get with my eyes closed. There's nothing there. There's nothing there, totally nothing there. Why should they even give these serious students at this serious level some of these questions? These are very serious level. We need serious questions. So Bell will be equal to Bell, so before reconstruction, isn't it? Yeah, equals Bell into 1 plus debt over equity into 1 minus T. All right. So pretty fast, because you've done the same thing, it'll allow me to move with speed. So beta equity of a levered firm. Are we able to see BEU? BEU is beta equity unlevered, which is the same as asset beta. Are we able to see BEU? 0. What here? 6. Thanks, Jane, and these ninjas who are here. So before reconstruction, what is our debt to equity? Before reconstruction, what is our debt to equity ratio? 1.2, Online, I cannot see anybody giving me. They've told me there, if you look at number 1, additional information number 1, existing debt to equity is 1.2. So 1.2 times 0.7. Because 1 minus tax is 30%. So 1 minus 0.3 is 0. What here? 7. So then, ladies and gentlemen, are you able to give me the final answer before reconstruction? How much is our Bell? Before reconstruction, how much is our Bell? And we're supposed to be taking a break for our Muslim brothers and sisters. So we have here 1.104. And then you go ahead and give us, in this case here, after reconstruction. After reconstruction, what is our Bell? So you see, number 1, they wanted us to give them bells. Number 2, they want us to give them KELs using CAPEM. And then number 3, the worker cars. So during our break, for those of you who don't pray at this time, I would want you to finish that question. And then I should be able to give that student who outperforms everyone else. We give them 1,000 bob, isn't it? No, I'm joking. I don't have money. I'm joking. Don't have money. You. Now, who is telling me the truth? Other students are saying it is 7. Rounding off error. 8.0287, something like that. Hey. Disaster, Disaster. Let's redo Roman 3. So the Bell before reconstruction 1.104, no problem. Bell after reconstruction 1.356, no problem. KEL before, no problem. KEL after, no problem. The only place we have a problem is in getting WACC. WACC. So WACC before reconstruction. WACC before reconstruction. So first of all, give us the weights. weights. So before reconstruction, have they given me debt to equity ratio? It is what here, somebody? It's 1.2, isn't it? So therefore, weight of debt will be 1.2 divided by itself plus 1, which will be 1.2 over 2.2, which gave you guys what figure? 0.5455. And therefore, weight of equity will be 1 minus that. 0.4545. Thank you very much. And therefore, our WACC will be weight of equity, cost of equity, weight of debt, cost of debt. After what year? After taxation. So then give me the weight of equity, 0.4545 times cost of equity before. Cost of equity before, there are guys who are saying this is wrong. Cost of equity before, there are guys who are saying that is wrong. What is the correct one? Cost of equity before, there are ninjas who are saying that is wrong. Most of them are saying it's right. Most of them are saying it is right. Most of them are saying, Mwalimu, that is right. This figure is right. So then we have here 0.4545 times cost of equity before, which is 12.624. Yeah, percent. Plus weight of debt, which is 0.4545 times cost of debt. Cost of debt is the same as what here? Risk free, isn't it? 54. I've used the wrong one, eh? Yeah, 54. 5455. Cost of debt. What is the cost of debt in this question? 6% times 0.7. That is what they did. Times 0.7. That is what they did. 8.02 something, isn't it? The guys who are saying 7.6, where were you getting it wrong? Where were you getting it wrong? The guys who are saying 7 point something. So the most important thing is that they should be able now to do it. Should it be tested? Should it be tested? They shall be able to do it. Is that okay, my good students? WD. Remember, WD is weight of debt. Weight of debt we discussed and said, if you're given here of 1.2, debt to equity, to get weight of debt, take 1.2 divided by itself plus 1. I gave you a shortcut. I gave you a shortcut. So you guys now can go and finish this question. Otherwise, now I'm on my 6th topic. I told you the remaining topics are not tough. Very, very easy. So now we are dealing with financial risk management. Risk management. I was joking, yeah. Thank you so much. I was joking. I wasn't serious. We shall overcome. So financial risk management, the very first risk that I would want us to manage here is what we call foreign exchange. Mentioned there, foreign exchange risk management. So of course, you know that as we exchange these currencies, there will always be what here? There will always be possibilities of making losses. It is those possibilities of making losses that I would want us to cover. So ladies and gentlemen, I would want us to start right away, first of all, by reminding students how this works. Assuming we have in this case here, Mr. Kamau. Mr. Kamau has sold goods, as an example, worth US dollars 1 million. Yeah. Exchange rate at equity. Exchange rate is given as 130, 128 to 130 Kenya shillings per US dollar, like that. So we are required to determine Mr. Kamau's sales in Kenya shillings. Have you written this before I do the introduction of this topic? Before I do the introduction to this topic, I want us to solve this question. Mr. Kamau has sold goods worth US dollars 1 million. Exchange rate given there is 128, 130 Kenya shillings per US dollar.